The stock market is currently closed, and the last reported closing price for SoFi Technologies Inc. was $28.54 on Friday, November 28, 2025. This closing figure marked an approximate 4.28% gain for the day, a move that, on the surface, looks like a simple continuation of its broader multi-month uptrend. However, the unexpected reality beneath that green candle is a subtle but significant shift in the narrative. The stock is no longer solely reacting to its own stellar execution, which it certainly maintains, but is now being strongly driven by macro positioning, specifically a sharp rotation back into high-growth financial technology plays following a temporary dip. Most investors are celebrating the closing price as a victory for the company's fundamentals, but the deeper insight is that institutional flows, previously cautious about the sector's valuation, are now moving with a conviction that suggests the market believes the Federal Reserve's rate cycle has definitively peaked, making SoFi's deposit-funded loan model materially more valuable going forward. This realization that the stock's recent strength is less about a new product announcement and more about an advantageous macro tailwind is what truly sets up the current tension between expectation and reality. The general belief among the retail and a significant part of the institutional community has been that SoFi as a high-growth fintech would always trade at a premium, justifying its valuation solely on member growth and the promise of its financial services productivity loop. The expectation is that the business, which finally achieved profitability, would simply continue to grow its way into its elevated multiples. The contrarian view, which the recent move hints at, is that its growth story is maturing into a highly leveraged interest rate play. The core challenge to the prevailing narrative is recognizing that the biggest catalyst for its next leg up is not a jump in new members, but the widening spread between the low cost of its member deposits, which are sticky thanks to its banking charter, and the rates it can charge on its personal and student loans. If rate cuts are on the horizon, as the market is beginning to price in, this spread becomes less volatile and more predictable, fundamentally de-risking the entire model in the eyes of large long-term asset managers. The stock's ability to hold the $28 level after its recent quarterly earnings beat, which was already baked in, shows that the next story is taking over: the value of its bank charter in a normalizing rate environment. Analyzing the recent stock movement, the intraday high of $29.89 before settling at $28.54 on Friday showcases a clear tug-of-war. The volume for the day was relatively heavy at nearly 27 million shares traded, indicating substantial institutional participation both on the buying side, pushing the price to its high, and on the profit-taking side, which brought it back down to close near the prior day's close, but still higher. This activity is a characteristic signature of a stock transitioning from being purely retail-driven momentum to institutional rotation. We see a significant increase in open interest on call options, especially for the January and March expiration cycles, a forward-looking bet that goes well beyond the next earnings report, reinforcing the long-term rate thesis. The movement has also been remarkably resilient against the broader sector's occasional wobbles. While traditional banks have faced pressure from loan loss reserves and slower commercial activity, SoFi's focus on high-quality consumer personal loans and its tech platform, Galileo, provides a crucial layer of insulation that institutional buyers appreciate right now. The consistent overperformance on the top and bottom lines for the last 4 quarters has set a very high bar, and the market is now demanding a confirmation that the profitability is durable, not just a one-off event. This is where the short-selling community comes into focus, as they attempt to exploit the discrepancy between the growth price and the current financial institution P/E ratio. Turning to the short side of the equation, SoFi is absolutely a battleground stock. The latest settlement data from mid-November shows a reported short interest of over 116 million shares. This is a considerable position, representing nearly 10% of the float and giving the stock a days-to-cover ratio hovering around 1.37. While this ratio is not in the extreme short squeeze territory of 5 or higher, the consistent, large dollar value of the short position suggests a deeply entrenched bear thesis. The primary argument from the short sellers, often amplified across financial forums, is centered on valuation and credit risk. They argue that a forward price-to-earnings ratio that still sits north of 50 is unjustifiable for a lending business, even one with a technology wrapper. They highlight potential credit quality deterioration, particularly in unsecured personal loans, should the economic environment weaken, pointing to minor upticks in delinquency rates as an early warning. Major short firms haven't been shy, with some reports indicating large positions held by quant funds who rely strictly on comparative PE multiples against legacy banks. For the retail investor, understanding this short-selling dynamic is crucial. First, the high short interest creates a coiled spring effect. Any unexpected good news or a market-wide liquidity event could trigger a violent short squeeze. Investors can monitor short interest data, which is publicly released twice a month, but more actionable data comes from tracking rising borrow rates, which is what short sellers pay to loan the shares. While specific borrow rates fluctuate daily, a steady increase signals rising demand from bears and higher costs for them to maintain their positions, often preceding a flurry of closing activity. Currently, the borrow costs have seen small, manageable spikes, but a sustained climb would be a major signal. Retail investors should check their brokerage's published data or use specialized short data websites to find this information. A key move is to watch the options chain. A sudden surge in call open interest far out of the money, combined with high short interest, can be a sign of speculative buyers betting on a short squeeze. What's your take on the rising short interest? Smart money or manipulation? The core business model of SoFi, which started as a student loan refinancing service, has evolved into a full-fledged, one-stop-shop digital financial institution. Its unique selling proposition is its integrated app-based ecosystem, the financial services productivity loop. This loop aims to capture a customer early with a simple product, like a free checking account or a small personal loan, and then cross-sell them higher-value products, like mortgages, investing accounts, and insurance. The real engine of this growth, and the part that supports the premium valuation, is the underlying technology platform, Galileo. Galileo is a business-to-business segment that powers the digital banking operations for other fintechs, essentially selling the rails of modern banking. This tech platform offers high-margin, predictable subscription revenue that is not tied to the volatile nature of lending, and its growth is what justifies the comparison to a technology company rather than a traditional bank. The recent acquisition of Wyndham Capital Mortgage was another strategic move to expand its lending capacity and lower its cost to originate, further cementing its ambition to control the entire financial stack. Looking ahead, the future outlook for SoFi hinges on three main catalysts. First, the continuation of its membership growth, coupled with an increase in the average number of products per member. This metric, more than any other, validates the success of the aforementioned loop strategy. Management is targeting aggressive growth here, and consistent execution will silence many of the valuation bears. Second, the performance of the technology platform. While lending remains the largest revenue generator, the market is giving massive credit to Galileo's potential to become the Amazon Web Services of fintech. Any major new client win for Galileo would be a significant sentiment booster. Third, and most importantly, is the macroeconomic environment. The long-awaited return of student loan repayments has been a net positive, but the biggest swing factor remains the Fed's rate policy. A stable or declining interest rate environment will allow SoFi to better manage its cost of funds and further expand its net interest margin, which is the key to sustained durable profitability. The company has already provided strong guidance for the coming year, forecasting substantial revenue growth and a clear path to generating GAAP profitability for the full year 2026. However, the risk remains in the credit quality of its loan book. If unemployment rises or consumer health deteriorates unexpectedly,
the short thesis on credit risk will gain traction, regardless of how fast the company is growing its membership. The final consideration for investors is managing the constant noise and the high volatility inherent in a stock like this. Active online communities on platforms like Reddit and X, Twitter, often debate the company's prospects with intense fervor, sometimes calling for coordinated action around options expiration or short interest dates. It is vital to remember that while retail sentiment provides crucial volume and momentum, it cannot override fundamental financial realities over the long term. For instance, chatter about high failed-to-deliver data, which refers to unsettled trades, is often a lagging indicator and not just evidence of manipulative, naked shorting as some online forums claim. Investors should use official SEC and FINRA data to assess the real trends, not just anecdotal claims. Monitoring institutional filings for firms with large short positions